to look at how land and building has increased. If you have your calculators, if we take away 1980 from 2030, then the increment is 50. 50. Yes, please pay attention to the top here. So though the increment is 50, but it's not 50 cedis, it's 50,000. It's 50,000, right? The increment is 50,000 because of the 3 zeros at the top. All right. Okay. So we move down. Still at B, equipment is the same as at 400,000. Plant and equipment is the same at 172,000. Inventory is the same at 640,000. Debtors is the same at 712,000. Bank is the same at 488,000. Right. Then we have cash, also the same at 46,000. We come down to equity liability, then we can see that equity has increased. And then equity has increased by also 50. So when we compare this and that, we can see that the increment is 50, right? So equity has also increased by 50. Okay. Then we compare loan. Loan is the same. And then building, right? So just like what we wrote for the first one, owners made an additional contribution of equity or an additional contribution of capital worth 50,000 in form of land and building, right? So let's go and write the okay. So B. All right. So we're saying that owners made an additional capital contribution or equity contribution worth 50,000 in form of land and building, right? In form of land and building. Okay. Let's see if we can make sense with the other items. Now we may have to compare C and then B. So we are going to compare C and then B. So pay attention to how things work here. Right. We are comparing the items one after the other. Right. One after the other. So here we're comparing C to B. If you look at land and building, C and B are the same. 230, 230. Office equipment is 400, 400. Plant and equipment is 172, 172. Inventory is 640, but here is 680. Right. So it means inventory has increased by a certain 40. Inventory was 640, but now inventory is 680. So inventory has gone up by a certain 40. Okay. Then we have debtors to be 712, and then 712. We have bank to be 488, 488. cash is the same at 46, 46. Okay, so pay attention. The only thing that went up around the asset, or then what went up here as part of the asset component is just inventory. Inventory went up by 40. So let's check if this increment also have bearing at the other end. Okay, so we look at equity. Equity is the same at 2944, 2944. Loan is at 860, 860. But payable has increased from 684 to 724. 724. So if you look at payable has increased by a certain 40. Okay, so what is payable? Payable is or refers to people that you buy from on credit, those that you bought from on credit, right? And then inventory is your stock, the stock that you trade in, right? So what would happen for those that you owe to increase by 40, and then those, your inventory or your stock to also increase by 40? What will happen? Sorry, let me take that again. What will happen for the stock that you trade or you sell, which is inventory, to go up by 40, and then those that you also owe also go up by 40? It may then suggest that probably you have bought on credit. Probably you might have bought on credit, right? So it could be that you have purchased on credit. Those that you owe, credit. Bought inventory, what 40,000 on 40. So if we put our mind around it, we are saying that it may suggest that purchased inventory worth 40,000 on credit. Okay, so let me put that down and then see. See. Okay, let me do one last one, and then I can pick comments from the class. Okay, so bought inventory worth 40,000 on credit.
Hello, Isaac, please, are you speaking? I'm not sure I can.
All right. So sorry, I got an interruption. Okay. So we've looked at three of the items. Now we may have to pick up on D. So you are going to compare D against C. D against C, right? We are comparing D against C. So if you look at land and building, it's the same. If you look at office equipment, it's the same. If you look at plant and equipment, it's the same. If you check with inventory, inventory has moved from 680 to 665, right? So inventory has declined or decreased, right? Inventory has gone down. Inventory has gone down. But what is the rate of decline in this? if you look at it, I think it's around 150. Sorry, 15. 15. So inventory has gone down by 15. Debtors has moved from 712 to 742. So we put our mind around it. Who are debtors? Who are debtors? Debtors are people who buy goods from you, your customers who promise to pay later, right? So if your inventory is going down and then your debtors is coming up, it means you have sold. Probably have sold for some credit. You have sold on credit. Your inventory is going down, whilst your debtors, those who owe you, is coming up. So it could be that you have sold. But let's see if that's all the effect that we can see here. So we can see debtors increase by a certain 30, right?
30,000.
Debtors has gone up by 30. Okay, then let's see. We have bank to be the same. Cash is the same. If we come down to equity, equity was at 2944, but now it has increased to 2959. So it means equity 2 has gone up by 15.
15.
So if we check on loan is the same, and then payable is the same. Okay, equity. If you remember, we said that equity has component of profit, right? So in an event when the business is getting profit, then it is added to equity, right? Because equity goes to the owners. So the 15 increment here that we see in equity suggests that there is profit, right? It means that the business has sold at a profit. Okay, let's see something. If you look at inventory reduced by 15. Inventory, which is the goods that you sell, has gone down by 15. When it went down by 15, those that owe you increased by 30, right? It means you have sold inventory at 15,000, right? In go down by 50, goes up by 30. So how do we put this to take questions from here? So if you have a question, you may have to now pick it from here, right? But I'll write a transaction before I take in the questions. Okay. So I'm saying that we can put this down as this. So entry cups. Sold inventory worth 15,000 for 30,000 on credit. If you have said this, it's an enough transaction. If you have said this, it's an enough transaction. But someone else want to be diabolic and add with a profit of 15,000 Ghana cedis, right? So either you say the first part or you say one in addition with the one in bracket, and then all of them they make one common sense, right? Okay, is there any question? Let me pick it from here. Is there any question? Ernestina, your hand was up earlier. Ernestina, your hand was up. Okay, Abbas.
So how do you capture the change in the equity, or is not needed?
The change in equity is early profit.
Okay, so it's
Right.
that it will be understood that 15,000 profit will go to the equity.
Yeah,
So
it will
there's
go
no
to
need writing
owners.
it down.
Well, so I said that there may not be a need of it, but if you want to write it, then this is how we capture it, right? So sold inventory worth 15,000 for 30,000. Impliedly, there was a profit component in this, in the 30,000 that we can see here, right? If you bought goods for 15,000 and you've been able to sell it for 30,000, it means you've made profit. Right. So the profit component is the 15,000. So if you want to show it that it affected equity, then you saying that with a profit of 15,000. And then already I have shown you that profit is an element of equity.
Yeah.
This is it. This is profit. Right. So profit is an element of equity. So if you say that with a profit of 15,000, everybody knows that it has increased equity.
Thank you.
All right. Is there any other question?
Yes, I also have a question.
All right.
So with the profit side, if the goods is sold on credit, why are we recording profit?
Okay, so remember that at a point in time, we taught something called accrual base of accounting and then cash base of accounting. The presumption is that a lot of businesses these days are using accrual basis. So when goods passes or when we exchange goods, right? When you make a sale and then the goods passes on from you to whoever gets it, since ownership is exchanged, we realize profit or we record profit or we record it as sales. We record revenue, right? So when the person agrees that he's going to make payment to you in a later year or in a later time, then we recognize revenue based on accrual concept, right? Based on accrual concept. So accrual concept just says that when you sell a good and then the person agrees to pay for it in a later time, treat it as revenue. When you also buy something and then you promise to pay in a later time, you also treat it as an expense, right? That you are incurring costs. So that's the concept of accrual, right? I hope you get it.
Yes, sir.
Great. Okay. For your colleagues who are joining with the names that I do not know, it becomes a little difficult to admit them, right? Okay. I hope these are the only questions. Ernestina, are you there? I'm hoping that you've understood it now. If not, let me pick your question and then continue.
Some people put a question in on the chat. So.
Oh, interesting. Let me go and check. Okay. Yeah, but in the meantime, Sophia, your hand is up.
Isaac.
Yes.
So I was asking how you get to know the payment was by check. That's column A and not cash, because you specifically mentioned check.
Okay. I'll show you that.
Okay.
I hope you are aware I shared this question in the chat room. The question that we are using,
yes,
I've
sir.
shared it long ago in the chat room.
My phone is going low and I'm joining with my iPad. So kindly let me in.
I didn't get you well though. Can you write the
I'll say my phone is going low.
Okay.
And I'm trying to join with my iPad. So please grant me access.
Okay. The name is what? Is it Christiana? Oh,
No, it's Fatia.
okay. Fatia.
Thank you.
All right. To the chat room. Yeah, Mavis.
Before we state the what is happening as in the transaction happening, we need the changes in the figures, like increase in equity of 15,000.
Not at all. Not at all. The way and manner we go by answering this is what I'm doing. All the analysis, you may have to do it in your head or somewhere in your on your question paper. If you dare do the analysis and you don't write the right transaction, you have failed. Right? You have failed.
All right.
Okay. Okay, so far you were the same person who asked the question in the chat room, right? Let me see.
Yes, sir.
Okay. Can you write owners increase their equity by 15,000 because they sold inventory? Oh no. So Albert, you can't say that. So it is just simply the business had made sales. You remember we told you that there was a certain concept called business entity concept, right? That the business's activity differs from the owners, right? So if we are saying that owners have increased their equity, how did they increase their equity? By they selling goods for 30,000. Anyways, but we are looking at facts that the business is running on its own, and then owners are also somewhere else. When we get profit, then we go and give to the owners. Of course, if they don't have anything to do, then they re-inject it into the business, right? Or because the business is just looking at equity as something belonging to owners, anytime that we get something for owners, we add it to equity. That's all. Okay. How did we see that the payment was in check or the contribution was in check? Okay. So anything in relation to bank, so far, is related to check. Anything in relation to bank is in relation also to check. So you can either say by bank or by check. Okay. Either by bank or by check. Yes, Nana Kwesi, last question and we go.
All right, Isaac, good evening.
Yeah.
So correct me if I'm wrong with the statements about to make. So the value of the inventory is 15,000. Okay. Now you decide to give it to your customers on a credit basis, and they pay a value of 1,000. Mean that you charge a price more than what you're supposed to charge, or is it because you give it so they are supposed to pay more than?
Okay, so you are looking at moral issues. Anyways, yes, of course, they have sold the goods, I think, at a price equal to 100% or something, right? That one will be an issue of moral something, right? Or ethics. But here we are just looking at the question as it is, right? We are looking at the question as it is. Nana, is it okay?
Okay, it's okay. So I just want to know if I can add it in the statement that we just made, a D part, that it was you give it to them on credit basis and you charge maybe plus something, or plus 2,000 CD instead of 5,000 CD. I'm just thinking if we can add it to that.
No. So where would that one come in? Let's go back to the answer area. This is where we have the answer. We're saying that sold inventory. The inventory was worth 15,000, and then you sold it for 30,000, right? So we are saying that if you take away the cost of the inventory from the 30,000, the 15,000 left is profit, right? It's profit. You know, the business is not running on a charity basis, right? So anything at all that they get on the cost is profit, right? Oh. Whether you are selling on credit or you are selling for cash, anything at all that you are getting beyond the cost of the item that you purchased becomes a profit, right? Oh. But maybe if you want to interrogate this the more, then we can look at the ethical issues and everything. But we cannot bring them here in the way we answer the questions.
All right, thank you.
Most welcome. Okay, we are continuing from E. So now we're going to compare E and then D. As we go on, things can be a bit diabolic, but you have to pay attention. Okay, so E and then D, we are looking at the increment or the decrement here. We can see that land and building is the same. Office equipment is the same. Plant and equipment is the same. Inventory is the same. Debtors has gone down by 15, right? By 15. Debtors has gone down by 15. So we're taking away this and that. The difference is 15. So debtors has gone down by 15. Okay. I'm sure you are aware who debtors are. Those who owe us. Those that owe the business. If what they owe is going down by 15, then it's clear that they may to pay or they have paid, right? They have paid something. They have paid part of what they owe you. That's why it is going down, right? That's why how much they owe you is going down. But when you look at cash, sorry, bank is the same first, and cash has gone up from 46 to 61. 46 to 61. So the increment here is also 15. 15. So it means that probably whatever that your debtors paid was in cash. Anyways, let's check through the others. If there are no other effects, then we can just put our transaction down. So equity is the same, loan is the same, and then payable is the same. Hence, the effect just has to do with debtors and then cash. So what is happening? It may then suggest that debtors have paid in cash 15,000, or you have received 15,000 from your debtors. A cash of 15,000 is received from your debtors. A cash of 15,000 is received from your debtors. Let's try to put this down and see if we, okay. Okay. Okay, so cash of 15,000 was received from debtors. Someone will say a cash receipt of 15,000 from debtors, right? A cash receipt of 15,000 from debtors. Simple, right? So you may have to put your transaction as simply as possible. Don't complicate the transaction. Okay, F. Let's look at F. Okay, now we're comparing F and E. Land and building is the same. Office equipment is the same. Plant and equipment is the same. Inventory is the same. Debtors is the same. Bank is gone down. Bank is gone down by how much? 184, right? The difference is 184. If you have your calculators, you can also be checking, right? But bank is gone down by 184,000. Okay, cash is the same. If we go down, equity is the same, loan is the same, but payable, which was 724, has gotten to 540. Which one is that also? Payable is those that we owe, those that you have bought goods from on credit, those that you owe and have promised that you pay later. Now you were owing them 724. With F, we have seen that we now owe them 540. Meanwhile, our bank has also gone down by a certain 184, right? So what has happened? What would happen for your bank account to reduce by 184, and those that you owe too would reduce by 184? It may suggest that you have gone to pay them. So you've paid a check of 184 to payable. 184,000 to payables. Okay. So that is it. As simple as that. Paid a check of 184,000 to payables. Okay, let's look at G. I had wanted to leave G for your discussion, but we will keep long, so I would have to discuss it with you. G, let's look at G. G, we have land and building still sitting at the same point. Office equipment is gone down by 40, right? From 400 to 360. Means office equipment has gone down by 40. Plant and equipment is the same. Inventory is the same. Debtors is gone up by 20. Debtors, those that owe you, has gone up by 20. Your bank is the same. Loan is the same. Payable is the same. Right. So where do we have the effect? We have the effect on three items. Office equipment goes down by 40. Debtors increase by 20. Your cash increased by 20. Right. So what is happening? You have inventory. You have office equipment. You have sold 40,000. 20,000 of it is on credit. And then 20,000 of it was received in cash. Right. So you sold 40,000 worth of office equipment for a cash of 20,000 and on credit of 20,000. So it was a partly payment, right? Or partly transaction. You sold partly for cash and then partly for credit. Okay, let me try and put this down and see if we can follow through. Yes. Vera, payable is the same as trade creditors, not and then debtors is the same as receivables. Okay. All right. So let's try to put this transaction now. G. You sold. Okay, mainly, let me even use this. When you sell a fixed asset, we call it disposed. But if I've mentioned sold, you'll still be marked right. Right. So disposal of office equipment. Oh, interesting. Equipment wealth 40,000. And partly on credit. Okay. Yes. So this is the transaction that took place. Okay. So disposal. Well, so you can say sold. Maybe when we talk about fixed assets, we talk about their sales as disposal, and then we talk about their if you bought it, then we're going to say purchased. We don't really use bought. Right. Okay. let's continue. But if you use either of them, you'll still be marked right because you are not accountant now, right? You are still learning some bit of accounting. You've not become accountant yet. So. Okay. Let's continue from H. So now we're looking at H. H against G. Okay. Land and building is still, we have office equipment going down from 360 to 350. So it has gone down by 10. Office equipment has gone down by 10. Okay. Then plant and equipment is the same. Inventory is the same. Debtors is the same. Bank is the same. Cash is the same. Well, equity is gone down by 10. Equity is gone down by 10. Loan is the same. Payable is the same. I was tempted to ask you which one is this. Anyways, but let's see. In this context, when your office equipment was going down by 50, those that it didn't affect your bank, neither did it affect your cash. So it means you've not sold it. It has nothing to do or bring in any check, they didn't bring any cash. So it cannot be sales, right? All what we saw was that office equipment has gone down and then our equity has also gone down. So what might be the issue? What will happen for office equipment to decrease by 10, to increase by, right? It could be that depreciation. Yes, I could say in depreciation. It could be a depreciation. I'm also saying that it could be that we've gifted it out to family and friends, right? So it could be that it's a drawing. It could be a drawing. If we want to think about it so carefully, we mainly would depreciate fixed asset, rather than giving old office equipment out to a friend, right? What we normally give is either money or inventory that we sell, right? But when it comes to fixed asset like this, a decrease in it, if it's not a sale, then we are looking at it as either a depreciation or something of a sort. It could mean that it has depreciated, or so we're saying that fixed asset, which is office equipment, has depreciated by 10,000 Ghana cedis. Okay. So Mavis is also saying revaluation loss. Okay. So someone else will say we've revalued fixed asset down by 10,000 Ghana cedis, right? We've revalued office equipment down by 10,000. So whichever that you see it from. Is better or something to her, right? So I would say written down value of CDs has been made on office equipment. This is how I will put it. A written down of 10,000 has been made on office equipment, which speaks just like a depreciation of 10,000 has been made on office equipment. A revaluation of 10,000 has been made. So if you're talk about it, Mavis, if you are talking about revaluation, you may have to talk about it as a downward revaluation. Okay. Let's see. We can now look at I. Let's see. Asking what is the drawing that belongs to the business for your personal gain, right? If you have used the office equipment for your personal gain, then we're going to call it drawing, right? Drawing. So it's not the drawing of money or withdrawal of money. We're looking at drawing of the asset or the item going into your personal use, right? Or going out as a gift. Okay. Okay. So let's look at I. With I, we can see office equipment to be the same. Sorry, land and building first. Land and building is the same. Office equipment is the same. Plant and equipment is the same. We can see inventory go down by 535, right? 535. If we do the subtraction, 535. Okay. Then we have debtors going up from 7.4 to 9.87. So debtors by 240. Okay, that's great. 240. Okay. So let's put that down. Debtors is increased by 240. Bank is the same. Cash is gone up. Cash gone up. Cash is gone up by 260, right? Yeah, 260. Cash is gone up by 260. Okay. So we've seen three effects already. Inventory going down by 535, debtors going up by 240, and then cash going up by 260. Okay. Then we can see equity moving from 2949 to 2914. So meaning equity has also gone down. Equity has gone down by how much? 35,000.
35.
Okay. For increment, for effects or so. Inventory is what you sell, right? What you sell has gone 535. So what might have happened for your inventory to go down so much like that? Probably have sold inventory, worth 535. But how much did you sell the inventory for? You sold it partly on credit and then partly for cash. So if we add these two together, maybe it should match up to 535, at least, so that we say that you break even. Yeah, so that we can say that you break even. But if we add the credit sale and then the cash sale, it gives you 500, right? It gives you 500. So it means that inventory worth 535 was sold for a total of 500. So what are we getting? We are getting a loss. Inventory of 535 was sold for 500. It means the organization has traded at a loss. If they had traded at a loss, then we also split the mode of sales, right? So how do I say this? I am going to say that, well, inventory worth 535,000 was sold for 500,000. Cash of 260,000 was received and then 24,000 was on credit, right? Inventory worth 35,000 or 355,000 was sold partly for cash of 360,000 and then partly on credit for 240,000. It's an enough transaction. You can end it, or you want to add that with a loss of 35,000, similar to what we saw, I think, at somewhere. Where do we even experience that? I think D, right? That's when we experience something of a sort. Okay, so let's go and write this down and see. This is a little diabolic, but okay. So I inventory wealth 5 inventory worth 535,000 was sold partly for cash of 260,000 and partly on credit for 240,000. All right. And then I'm saying that if you want to be diabolic a little, then you see that with a loss of 35,000. Okay. Okay. Let's see if we can look at the last one. The last one, I'll leave it for you to do it. Okay. So I need
Isaac.
just one person to analyze it, and then you go.
Isaac,
Yes.
with the can we also
Okay.
with a loss of 35,000, can we also say that the business gave a discount of 35,000? Can we write that?
Can you come again with the last thing?
Can we also write? You said with a loss of 35,000. I'm asking if I can also say that the business gave a discount of 35,000. Can I write that also?
Yes, you can say that the sales came with a discount of 35,000, and then it will still make a sense.
Okay.
Right. Someone else would even say, well, why can't we look at the 35,000 also as goods that you also gifted out? Maybe you gave it for charity. It's a little open door, but if you want to look at one complete transaction, then it's either at a loss or at a discount. Right? It's either at a loss or at a discount, rather than you also gifting this elsewhere. All right. So yeah, someone else also wrote the transaction in the chat box. The person says that, can we say, yes, I think I said this early on, that it's a inventory worth 535 sold for 5,000 for cash. Then you state the cash amount, then partly for credit, you state the credit amount. Okay. Is there any? Okay. So I said I was going to leave the last transaction for your analysis. All right. So who analyzed that for us? I can see someone talk about it in the chat window, but I'll give a blind eye to that. Yes, Mavis.
Okay. A cash of 200,000 was drawn and deposited at the bank.
Okay. So say what you said again, so that I'll talk about what you just said. Just see the same thing as you mentioned.
Okay. Cash of 200,000 Ghana cedis was drawn and deposited at the bank.
Was drawn. So was drawn. What is the meaning of was drawn?
Okay, maybe taken from the sale or something.
Okay. So if we take away was drawn, how do we put it?
Okay, cash of 200,000 Ghana cedis was deposited at the bank.
Simple. So let's cancel the was drawn. And then the last thing that you said, it's enough, the transaction. Right. Cash of 200,000 was deposited at the bank. But which bank? The business's bank, right? It's okay. You don't mind me. Right. So cash of 200,000 was paid, was deposited, was lodged at the bank. Simple. Right. Okay. Let me look at the chat room. I think cash deposit of 200,000 was deposited. So Vera was deposited again. So well, it's fine. Anyways, we are not really marking some of these things. But cash of 200K, Albert, so your 200K will be marked down. And so the K, and then you not writing with the currency sign will not be accepted. Right. So fire, you writing without the currency sign will not be accepted. Okay. I hope we've had a very good discussion on accounting equation. Maybe some other day when we are drawing closer to exam, we can pick one last or two questions in this area and then look at it again. If not, I think down with you on accounting equation. If there are any other questions, I'll pick it. If not, we're going to start something on budgeting. Yes, Abbas.
Is there a case where they would rather give us the English for us to do the table?
Be a case like where they give you the transactions as we have here, as we have here. This transaction, they appear here for you to rather develop the table, right? There can be a case like that, but student and then the undergrad done at your level. In any case, it's likely that I will pick a question of a sort in that area, right? In that area, with you, see how we can also answer a question of a sort. But if you pick the past questions, especially the main exam past questions, this is the structure of the questions that comes, right? This is the structure of the questions that comes. Okay, Akofi, I will share with Teresa so that she gets it to you. Okay, yeah, Beatrice, your hand is up.
Yes, as you see, in the case where land and building, in this example, land and buildings increase. In the case where it reduces, how do you describe that kind of transaction? Is it that how do you describe that transaction?
Okay, so well, quickly, let me say that it's very difficult for land to decrease, right? Land does not really decrease anyways. Rather, land would appreciate. If they've attached buildings to it and then you are seeing a decrease in land and building, then your conversation will be that maybe you hold the building if you are realizing any increment in debtors, in cash, or in how do you call it, in bank, right? So issues that would come from debtors if you are selling on credit, issues that borders on sales or your bank or your cash. It's okay, Beatrice. So if it's about sales, then you should see a corresponding increment. If your land is going down, if your land and building is going down and then it's about sales, then it should affect either bank, cash, or debtors, either of the three, right? Or maybe it can affect all the three. It means that you might have sold partly for credit, partly for cash, and then partly for check, right? So sales would affect all the three, or any of the three, or part of the three,
Okay.
right? If you don't see a corresponding arrangement with just three elements, then you may want to look at it whether it has also affected equity. And then if the effect on equity is not positive but negative, then it means you can look at it as a revaluation or a written off value, a written down value, a depreciation, right? Or maybe you can look at it as how Vera will look at it, a gifting, right? A drawing, right? Okay.
Okay. All right. Thank you.
You're welcome. We're going to pick up on sorry. Give me a second. I'm told some people who still do not have the question, so let me just send it to the chat room one more time, and then we'll continue. Interesting. I'm facing some challenges with me getting the item to the chat room. One second. Okay, I can't get the, but for MBA student, maybe me or Raymond, you can send it to your main group. And then for weekend students, Teresa, I have shared with you, so you can share with your colleagues. Yeah, Percy, let's listen to you.
Yes. Thank you, please. For the question first, this accounting equation question. What I thought first was that I was going to compare all the column to the base column. So I realized that it was a deviation, but I want to know if it's B compared to the base, it would have been 0, right?
Okay, so I will say yes to your last statement. Yeah, it would have been 0, right?
I see. Right.
Yeah, because we are looking at the increment that happened over the period. You see, for the accounting equation, it's a periodic statement, right? It's a periodic statement. So every day something is added. Every time when you buy something today, or when you buy something now, and then in the next minute you buy something again, it affects the old one. If you buy another thing, it affects the previous, right? So that's how the accounting equation is.
Okay, thank you.
So you cannot what happened yesterday straight to what happened maybe in right.
Thank you.
Welcome, please. Maybe someday I'll pick question with you on this very question. It's an interesting one. I'll pick it with you someday. Maybe if we fit in the week. But today, I want to pick budgeting with you perspective. It looks a little different from all the budgeting questions that you may see. That I'll take my time so that we can all get it. When you prepare a budget, especially for a manufacturer, some stuff that you have to pay attention to, right? There are some stuff, basic stuff that you have attention to. Number one, organizations would want to look at the market. Is the market ready to convert? So normally what they want to think about is what quantities would the market demand? What quantities would the market demand? Right. So if you are talking about market demand, then you are talking about sales. How many quantities can I sell at every period, at any point in time? Right. So we can look at budgets from quarters, from months, from weeks, whatsoever. But maybe in our discussion, we'll be looking at monthly and then quarterly. Right. Monthly and then quarterly. So if it's about month, we are looking at how many quantities or how many units of product can you sell in that, how many quantities can you trade, can you sell, right? So that becomes sales demand, sales unit, sales forecast. If you are planning, if you are about to call it a plan sales, what you plan to sell, the units that you plan to sell. So let's put down. If it's about sales, or if you want to buy a sales budget, then you may be looking at sales budget. You'll be looking at quantities that you want to sell. So sales unit. I'm saying that sales unit can be referred to as sales forecast. So forecast. If you see people calling it forecast, is the same. People may call it planned sales, right? People may call it expected sales. Expected sales, right? People will call it quantity. I cannot write everything, but these are how they would describe the unit or the quantities of product that you expect to sell, you plan to sell, you forecast to sell, right? These are the units that you, in your mind as a manufacturer or based on your market survey, you want to sell. Okay. Apart from this, as someone who manufactures or who sells, you also want to look at how much can they buy this? How much? What price would they pay for this? So selling price, right? So you can also forecast your selling price, right? You can forecast your selling price. So selling price becomes another thing that we think through when we are looking at sales budget. Sales budget. Okay. From the sales budget, you gain some confidence that now based on these quantities that I can sell or I want to sell, I have to produce this. So production budget becomes the second thing to think about. So production budget. Production budget. You cannot start producing without you knowing what the market is ready to acquire.
Please.
Yes. Sorry, there was a question?
No, please, it was about the correction you just made.
Okay, thank you. Okay, so production budget. Anyways, if organizations would want to sell a certain quantity, then how many quantities would they also have to produce? Then you would have to also think about the fact that, well, since the market is ready to buy 2, produce 2. That's all, right? If the market is ready to buy 2, produce 2. Cost maybe may not have. So the first thing that comes to mind when you want to produce or when you're looking at your production budget is the units that you can sell, the units that you are ready to sell, right? So simply, the sales unit becomes the first element that you think about as a producer, right? As a producer, your sales unit becomes the next element or becomes the main factor of your production budget, right? You want to produce what you are ready to sell. You want to produce the quantities that you can sell. Of course, if you want to be prudent a bit, or you have space and you want to keep some of the things that you sell, then you may want to add something extra to the units that you can sell, so that you can leave them down against another time. So take into consideration what I said. You want to leave something now for another time. So you leave something today for tomorrow. If organization wants to sell, then they want to with left account, or in terms of production, we are referring to it as closing stock. In terms, it's a leftover, right? In terms of the kitchen, it's a left, but in terms of right. So there's by means a policy line in the question to guide this, right? It's guided in the question. So you may find a policy in the end, policy in the question that talks about ending stock, right? And then which stock are we talking about? We are talking about stock of finished goods. Stock of finished goods. What you are ready to sell. Stock that you are ready to sell, right? Meanwhile, you are not selling it today, maybe another time. Some share recording those who right group of people come from. Miriam, is it weekend or EMBA?
Yeah.
EMN.
Group. All right.
Yeah. Okay.
Thanks.
Okay. Okay. So we're saying that ending stock relates to finished goods. Yes.
Yes, please, this is Magdale. My network started messing up, so can you please allow maybe another person from group 2 to also record, because my network keeps dropping in. Please.
Okay. Who has a strong network from group 2? Albert, you have a good network, oh?
Yusuf.
Can we have some?
Yusuf and Posh. One of them.
All right.
Me, I'm currently working with my machine, so
I think I've allowed the. Okay. So
thank you, Ike.
Saying that and then talk. Okay, thank you. Albert has sent the question. You don't have it. Okay. Ending stock policy guided, right, in the question. And then mainly then in another element under production budget is starting stock. So if you listen to my conversation earlier, I said that you leave something today for tomorrow, right? So invariably, for opening stock, it's a left, which is becoming the starting stock for tomorrow. Right. So ending stock of becomes stock of ending stock of today becomes the starting stock, the starting stock of the next day or tomorrow. So simply I'll say that when you talk about starting stock, is the ending stock, let me just say ES, the ending stock of, say, period 1, right, which becomes the starting stock of period 2, or if you care to know, let's use month 1 and then month 2, right? So period 1's ending stock becomes the starting stock of period 2 or month 2. Okay, that's the simplest conversation ever that you could have on this. All right. Then if you look at this element, the next item that becomes important when you are looking at your production budget is cost elements. So cost of production, how much you incurred in producing, right? How much you incurred in producing. So cost of production becomes the next item. But there are different components of cost or different cost variables. So number one cost variable that you can think about is one, material that you use, right? So we call it direct material that you use in producing. Then apart from material, you may incur cost on labor. So we can think about direct labor cost. All right. Then you may incur other costs. If you set out to list all the costs, I think we won't finish. But we are going to classify all the other costs into what we refer to as production overhead costs. Production or fixed overhead costs. All right. But usually there are issues with overhead costs. Usually there are issues with overhead costs that we may have to deal with. So for overhead costs, I'll put asterisk on it, right? Just to indicate to you that there are issues with overhead costs, that sometimes you may have to deal with them. Okay, then we can move down to the last part of budget that organizations may want to think about, what is so important to their operation is cash budget. Okay, cash budget has two key components, right? Cash budget has two key components. In your cash budget, you are looking at monies that you are receiving into the business and then monies that you are going to pay out to other people or you are paying out from the business. So keenly, your cash budget would have A, all your receipts, and then it would have B, your payment. So this is the outlook of the budgets that we are setting out to prepare this evening. But usually, this cash budget would compel us to work out some few things, right? Usually, this cash budget would compel us to do some few workings. So you may have to note this, right? That there are some workings that we have to do because of cash budget, right? Which workings are these? The cash budget will compel us to work out something called one, schedule of receipts from your customers, right? So if you sell, usually there are policies that we give to customers that, well, because we like you people, pay some now and then pay some later. Because we like you, or because we want to maintain good relationship with you as a business partners, pay some now and then pay some later, right? That's the payment policy or the credit policies that we give to customers, right? So the workings will come as a result of credit policies, right? And then all these will be found in the question, right? All these will be found in the question. Credit policies. The credit policies will compel us to work out these few things. The second working will be schedule of payment. Schedule of payment to those that you buy from on credit. Not too long ago, we looked at some of these things, right? So if you have suppliers that you promise to pay later, then you are looking at your arrangement with them. Sometimes you arrange that you pay some today, pay some tomorrow, pay some now, pay some at a later date, right? And then this is also a credit policy in the question that you want to look out for. Okay, all right. From here, I think we can set out to look at the question that is before us. Okay. Okay. Mainly when you are reading accounting questions, I advise that you read the requirement first, at least so that you know exactly what you are about to do. Okay, so this is the required. You are required to prepare for the next 6 months, and budgeting is recorded in 2024. It will be January, February, March, up to June, 6 months. The budget that we are preparing 6 months to June, that will be, or that's the requirement of this question under consideration. Which budgets are you preparing? You are preparing 1, sales budget, 2, production budget, 3, schedule of payment to suppliers, schedule of receipt from debtors. Debtors are the same as customers, don't forget. Anyway, then we have E, require the cash budget. Cash budget. F here says that recommend to management of Gilbert and Sandals how to finance the deficit, if any, and how to invest the surplus, if any, as per the cash budget. So this is the question before us. Let's see anyways. So if we are going for, we are looking at information that relate to looking at and scans and process them to the specific needs of customers. GH Leather. S&G bought equipment for processing cost 300,000 Ghana cedis. So this element is important. Let me highlight it. It's cost of equipment. Cost of equipment becomes important, possibly for depreciation. I'll tell you, or you come back to it again. The equipment is expected to have 5-year life. The 5-year life is equally important for depreciation. I'll come back to it. With no residual value. No residual value is also important for depreciation. So all these elements, I've indicated them as relevant for depreciation. Okay. The company bought 1,000 of hides and skins on the first day of operation. On the first day of operation, the business would try it, whether everything is in place. So the boss country made them test their machines. Of course, let's forget about that. We're talking about sales forecast. Sales unit. We said it becomes the first sales budget. So this information is as relevant for your sales budget. For the first 2 months, would increase by 15%. Okay. So we have to pay attention to that information also. It continues to say that the selling price of each unit will be 120,000, 120 cedis, 120 cedis for the first 4 months, with a 20% increase thereafter. So it means that after the first 4 months, your selling price would also increase by 20%. And then that increment will be for the fifth and then the sixth month because of the word thereafter. Okay. Then it tells us that the cost of production of each unit is specified as follows: cost of hides and skins purchase. The question was not too direct, but they've told you that hides and skins is the units that they will process into something else, right? Into something else, GH leather. So the hides and skins becomes the direct material in this context. So the direct material cost per unit is 40. Direct labor cost should be 50% of the cost of hides and skins. So it means that labor cost is of 40 and 20. And fixed overhead 30% of hides and skins, which should be 12 or 12. So that is the cost element that you have to consider. Let's continue with the reading. The fixed overhead cost per unit includes an allocation of depreciation. I told you there was an issue with overhead costs, right? And then that issue borders on depreciation. Anyways, it tells us that depreciation is calculated straight line basis. They are given education or to work out how depreciation. It said that to work out depreciation using straight line method or straight line basis. Depreciation indicators. Okay, so we know what to do with depreciation. I'll pick it again. The following month, we're telling you the credit policies that's given you. Customers started to pay 60% in the month of sale, and then the remaining customers also. Wages are paid as they are incurred in production. Fixed overhead costs incurred are paid later. Still, all these are policy elements. All right. Other non-production costs are selling and administrative expenses are expected to be 12,000, are paid as they are incurred. Right, as they are incurred. Okay. The stock of finished goods, that's GH ladder, at the end of each month will be sufficient to satisfy 25% of planned sale of the following month. Remember, I told you that there will be a policy to guide your ending stock. And then there's that policy, right? Stock of finished goods at the end of each month will be sufficient to satisfy 25% of planned sale of the following month. Planned sale of the following month is equally important of the following month. Planned sale of the following month. Okay. The hides and skins at the end of each month is held constant. This is raw material. And then anytime that we hear of our raw material budget, our raw material held constant at any unit, it would prevent us from preparing a raw material budget, right? Or it's a restriction for us not to prepare a raw material budget. Okay. Hello, I'm told my line is breaking. Is it better?
It's still breaking.
Keep going off and on.
Yeah, it's really breaking.
Interesting. Okay. But indicate to me when it's okay at any point.
We can hear you, though. We can hear you, though.
Great.
I can hear you.
Great. Okay. So we're saying that stocks of
The line is breaking.
Skins at the end of each month is held constant. When we get this statement,
Is that the line is breaking?
it will prevent it's breaking. Okay, so give me 2 minutes. My internet, I'm sure. Please give me to check.
Yes, for now it's better.
Yes, it's
All
better
right.
now.
Please, we heard you clearly.
Okay. So I have to make myself the host again so that I can share my screen. Oh, who is it? Teresa, you are the main host now. So it means Teresa, you have to make me a co-host from this line that I've raised my hand?
Hi, Isaac. So I earlier mentioned in the group chat that you made this device the co-host instead because the other one is disconnected. So I'm not even with that device at all.
Yes, please make me the host too as well.
Interesting. So we've all lost the
Yes, we
host,
are off. Yes.
and then it's gone on the other device. It's your other device which is the host.
Exactly.
And then you are not using that one.
It's not here at all. It's not like
interesting. Where is that?
Oh,
it's at work. It's still connected, but it's at work, and I'm at home.
Oh, okay. Give me a second. I mean, I have to get someone to get this for me. Please give me a second. I'll get back. I have to make one or two. All right. So sorry to have kept you for this long. If we can get back those who are recording to continue with the recording. Let me see those who are recording. Okay, I think they are still recording anyways. Okay.
Yeah,
we can continue. All right. I can't see you. Okay. All right. So let's see if we can start the budget preparation. We may want to start with the first one, which is sales budget. Please allow me to use Excel to do this so that we can get a good budget. And then you may have to listen and then pay a very close attention to me whilst I go through the workings in terms of the budget. Remember, we have said that for the first 2 months, the sales unit will be 10,000, and then the increment thereafter, month on month will be 15%. The increment month on month will be 15%. So that's what we're going to work with. All right. So I'm trying to show my Excel page. Then we can use that. Okay. So I'm doing this in books of GNS. The first budget that I'm preparing, which is A, is sales budget. Sales budget. All right. Because he said I should do budget for 6 months, let's see how I would put that. Let's see how we're going to put that. So I would have the first column to represent details, right? So details. Then I would label here to be my month 1, right? In this case, I think we can use January. So let's use January. So January, I'm doing for 6 months. So this is what I get. January, February, March, April, May. Then I'll put total here. Total here. Okay. What do I put under the sales budget? We said the first element that comes under the sales budget is expected sales, planned sale, forecast sales, sales unit. I prefer using sales unit a lot. So sales unit, sales units. Sales unit for month 1 and 2 are 10,000. Okay. So month 2 will be 10,000. Okay. But month 3, they said that it increased by 15% month on month. Month on month. So it means every month our sales would increase by 15%. Every month. Every month our sales would increase by 15%. So how do we do it? If we are working out for month, let me do a workings here. So workings. Okay. I want to do sales unit. I want to get a sales unit for, say, month, March. Let's talk about March. March sales unit will be equal to 15% of, or 15% multiplied by February's planned sale or sales unit, right, which is 10,000, right? And then you would add it to 10,000, which is February, right? So 10,000, which is the planned sale of February, you compute 15% of it, and then you add it to that, right? You add it to that. So what do we get? 15% of the first of the 10,000 gives how much? Whatever that you get, you add to that. So you're going to get
10,000.
Okay. So I'm just going to work it out straightforward.
11,500.
Someone else, okay, 11,500. Someone else can say that, well, going through all this is a bit difficult. Why can't we do 1.15 times 10,000? 10,000. And then that gives us a very simple working or a very straightforward answer, which is 11,500, right? So if you want to also work out something for April, then that would be 11,500 plus 15% of 11,500.
1.155.
Okay, so let's see. So 11,500 plus. Yes, Vera.
It says that 10,000, the sales forecast is 10,000 units for the first 4 months.
Did you say 4 months or 2?
Please, did I miss the question? I thought I saw
so
4 months.
I'm showing the question again.
Because I wrote it.
So first 4 months.
Okay, so let's read it again. This is a question.
Okay, it's 2. It's 2, sorry.
Were forecasted.
It's 2. Yeah, it's 2. It's
Okay,
2, sorry.
so it's rather the selling price, which was given as 120 for the first 4 months.
4 months, okay. Yes, it's 2.
Okay, so let's continue. Quick. All right. All right. Okay, so quickly, I'm working out with the 1.15, which I think it's very simple concept, right? Okay, so if you compute for April, what do you get? What do you get for April?
It's the same thing.
13,225.
We're gonna get 1922 something.
13,225.
Okay, let's see if that's true. Excel will do a very simple job for us. Thank you. So 13,225. Okay, I think I didn't put the percentage sign here. Okay, so I'm going to still use 1.15 times 11,500. Sorry. So if you come to May, we're going to continue the same process, right? May will be 13,225 plus 15% times 13,225. Right. So I'm going to continue. So tell me what you are going to get, and then I will put it down for you.
15,208.75.
Okay.
Hello, Ike.
75.
Yes.
Please, I'm not getting the 13,225. How did you get that?
Okay, so they said that the increment is month on month, right?
Yes.
The increment is month on month. So if you have computed for March, we are saying that for April, it will be 11,500 plus 15% of 11,500. And then that's what we have done here. That's what we have done here. Right.
And I'm getting 1725 rather.
Oh, 1725.
Yes, please.
Add it to the 11,500.
Okay. Sorry.
Okay.
Thank you.
Welcome. May will be something else that we've mentioned. Okay. We are going to sell GH leather. What is it about? Can we sell a half leather? If we cannot do that, then it means we may have to. If we cannot, the item that we are selling, if you cannot sell half of it, then it means you have to run the figure into the nearest whole number. So something of a sort, we may have to run it to 15,209. Right, 15,209. Something like this. We may have to run it to 15,209. I hope we understand that. Okay. Let me continue. If we come to June would also be, I think, let's see. We may equally have to run June into the nearest whole. So this is what I'll do with this. I'm going to run it into a nearest whole number. Okay. Then I'll also change this into a nearest whole number. Okay. Then I'll find the total. I would then have to find the total. So we have to add from January to June. We have to add from January to June. Okay. So that gives us 77423. So we can make it 424. Okay, 424. All right. Then we can look at the selling price, which is the next element under sales budget. The selling price. I may want to put down the currency sign, right? I'll have to put down the currency sign. So I'll put down the currency sign for all of the months. Then I bring in the selling price. Okay. The selling price for the first 4 months is 120 cedis. For the first 4 months is 120 cedis. So from January to April, 120 cedis. But they said that it increased thereafter by how much? 20%. Yes, you can use commerce in between. You can use commerce. But mainly, I do not want to use commerce for the sales unit. I'd rather use it in the values or for the values. Okay. So for the first 4 months, selling price is 120,000. And then that's what I have here. But it said that it increased further or thereafter by 20%. 20%. And then I said it's so important to take into consideration this word, right? Thereafter. So if you are computing the selling price for month 5, it would also be like this.
Like UPSA.
There are feedbacks. There are feedbacks. Sorry, if your mic is on, check it out. So I'm looking at workings for selling price. Selling price. So I need selling price for May, right? Selling price for May. And then my selling price for May will be 120 cedis plus an open bracket, 20% of 120 cedis. Okay. So what do we get? What do we get with that? That will be
144.
4,000.
144. Most of the web data, it suggests that June 2 would have 144.
144.
Right.
Yeah.
144. So June 2 will maintain 144 because of the word thereafter. Here, you may not have any total, so I can highlight that in yellow, right? There will not be any total here. Okay, so based on this, I can find the sales value. And then the sales value will be the selling price times the sales unit, right? The selling price times the sales unit. So that will be 10,000, as seen here, multiplied by the sales unit. Okay. So we're getting 1250.
You have a sticker like something like that I can post.
Not here.
Isaac, we can find anything. I think you're also muted.
Interesting. Interesting. Okay, so I'm trying to generate the sales values. So if I want to generate the sales values for month 1, I'll multiply the selling price by the sales unit. For month 2, which is February, I'll multiply the selling price for that period by the sales unit. And then I'll do that for the rest of the months up to June, right? So my sales values for June is just a function of the sales unit of 17,490 times 144. And that is generating me the figure that you can see here. From here, I may have to find the total, right? So I do a sum of it. I may have to find the total of this. So I find a sum of it. Okay. Okay. And that becomes my total sales value. From here, I can prepare my production budget. From here, I can prepare my production budget. And then me prepare my production budget, there are some elements that we said we have to pay attention to. Your sales unit store, and then your ending stock. Your sales unit, and then your ending stock. And then we said that after you have even gotten that, the rest becomes a little simpler for you to do, right? So B, we are preparing production budget. I am going to copy and paste, but maybe at your level in the exam, you may have to rewrite, right? You may have to rewrite this. So production budget. Yes, Vera. Yeah, Seto.
Isaac, please, how did we get to the total of the sales value? How
The
did we
sales
arrive
value.
at the total? Yes, please.
So the sales value is just a function of the selling price and then the sales unit, right? So we said the sales unit multiplied by selling price, right? That gave us the sales values. That's what we said.
So the sales
Is
value
okay?
for total, the total part is what I don't get.
This one?
Because we don't have a selling price at the total part.
Yeah, so we added everything from January to June.
Oh, okay. All right. Thank you.
We are adding everything. Okay. All right. Sorry. Okay. So from here, we add ending stock. So we're going to add ending stock to the sales unit. So we add ending stock. And that I said it has policy to deal with. Yes, Loretta.
please, the sales value for June, I'm seeing a 9 somewhere. That's not supposed to be there. Maybe I'm wrong.
Okay. The sales value for June and May. Okay. You said you're seeing some nine be there.
Yes, should be zero. The sales value for June.
9 should be 0.
Oh, okay.
Okay. This one?
Yes.
All right. I think it's dependent on your running. If you are running it, then the figures may change a little. But for me, because I'm using Excel, okay, let me hear you.
17490 by 144 is 2518560.
27. Can you come again? Sorry.
17490.
Okay.
By 144.
17490 times 144
is 25.
Yeah, so I'm sure because I am running, if you open this up a bit, the figures there will change. This one. And then recording the as 9. So your figure there is active. So let me change this to the right figure that we are using down there. So we're using 17490. Okay. Yeah, so that this one can change to the 0. Okay. All right. Then I think this one too, it will be appropriate that I change it.
Hello, Isaac.
Yes, 1520.
I think you should just maintain the figures, consideration all the 0.6 at the end. If it's 7, if you do 17 for 9, 0.06 times 144.5 million. So it's the same.
But the May is okay. The May is okay.
Okay. All right. But what I want to mention is that because on the day you are going to work with whole numbers, it will be appropriate that I maintain the whole numbers as it is here so that your answers, well, I'm not saying this question is coming anyways, so that in case you meet something of a similar nature, you may not confuse your answers. Oh, when I worked on with Isaac, we got something like this. And then right now what I'm getting is different. So you confuse yourself. So let's maintain this one for now. It's okay? Agreed. Here we go. Okay. So yes. Abed, your voice is so distant. We can't hear you. Yeah, Abed. I don't know whether it's only me who cannot hear Abed. Then it means I have to continue.
Can you hear me?
Yes, I can hear you now.
Okay, so I was saying that I keep on calculating the figure for me, right? And I keep on getting 15,250. 15,250.
15,250.
Yes.
How come? Okay, what do we say May is? We said May is let's see. May is when you multiply 15% by 13,500, then you add it to 13,500. Right. What do we get? Let's try to see. This is what I'm getting here.
Yeah,
15,250.
yes.
Okay.
Yeah.
But where do we get the 15,209?
Yeah, that's what I'm asking.
Interesting. Okay, let me see.
And that was 15% of the 13.
15% of 13,225. And then we
Plus.
added
13.
plus 35 itself. That was how come we arrived.
13,225. Multiply by. Okay, so I think you and I are making a mistake with the figures. So it's rather 13,225. Or maybe I made a mistake with this figure here. 13,225.
Yeah, the figures are correct.
Uh-huh. Yeah. So that's the figure here.
Okay. It was first 13,500. Thank you.
Okay. So we're going to maintain the 15,209. Okay. All right. So now we want to look at the policy on ending stock. The policy on ending stock. Who can read that session? I'm sure we all saw it. Who can read that session? That very portion of policy on ending stock. This is it. It says that stock of finished goods at the end of each month will be sufficient to satisfy 25% of planned sales. Remember, if you're talking about planned sale, we are talking about expected sales unit. So if we can put this in a different language, we are saying that stock of finished goods at the end of January should be 25% of planned sale of the following month. In place of the following month, we can put February, right? So January's ending sales or ending stock should be 25% of planned sale of February. February should be 25% of March. March should be that of, in that order, right? So let's go and then see if we can put this into practice. Okay, so ending stock of January will be 25% of the planned sale of the following month, which is this. Okay, and then if you come to February, it will be 25%.
Isaac, you are off. You've muted yourself, I think.
Sorry, I think I got a call. I've handed. Okay, so 25% of planned sale of the following month, and then the following month will be March, right? If you come to March, it will be 25% of that of April, right? Okay, but because we are looking at, yes, Beatrice.
Yes, Isaac. Kindly, if you could kindly start from the ending stock. I went off, so I'm lost, please.
So the policy says that it should be 25% of planned sale of the following month. 25% of the following month. So ending stock of month 1 is 25% of planned sale of February, right? So we multiply 25% by 10,000. If you come to March, February, it's 25% of 11,500. Now we are at March. March will be 25% of 13,225, right? And then going forward, April will be 25% of 15,209. June, May will be 25% of 17,990. It's okay, Beatrice.
Yes, please. Thank you.
So what would June be?
That's a question that we have to ask ourselves. What would June be? What would June be? Right now, because they gave us a certain rate to vary the planned sale, it means we could have computed the planned sale for July. Is it true? Could we have estimated July's planned sale? Yes. We could have estimated July's planned sale. if we had done that, then it can help us to compute the ending stock of June. Simple. Right. So we may have to compute the planned sale of July to help us compute that of June ending stock. Okay. But we've already said that we may want to maintain a whole numbers here. So how's my battery running down? 1 second, let me connect. All right. So we're still looking at ending stock. But I'm saying that we want to maintain this in whole numbers, right? So it will be 3306. 3306. Then this one will be 3802. Then this is going to be 4373. 4313. Okay. Let's estimate the planned sale for.
Isaac.
Yes.
Hello, Isaac.
Yes.
Please, is it not 5% of 13225 or 15209?
I didn't get you. What? I didn't get you.
Where you kept the 3802.
Okay. This one. It's 25%
yes,
of this. 25% of this. 25% of this. What do you get?
Oh, okay. I get it. It's fine. You can move on, please. Thank you.
All right. So we're looking at estimates for July. Planned sale of July. Okay. So planned sale of July will be 1.15 times 17490. Right. Okay. If you do that, what do you get?
2114.
No, what are we multiplying by what? We are multiplying what by what?
We are finding planned sales or the unit sales unit for July. We want to estimate that to help us compute the ending stock for June.
Uh-huh.
Here is the ending stock, and then that's what we're trying to estimate.
Yes.
And that is 25%.
Sorry, is that
there's
what?
a feedback. There's a feedback.
What?
01114. Okay. So we can say that this is 5029, right? 5029. 5029.
Hey.
Okay.
Please, oh. I thought you said we're calculating 15% of 17490.
So you have to really follow me.
Yeah, please, I'm following. And please, you said we are supposed to calculate 15% of the estimated sales.
Your sales unit
for
right,
July.
For July. That's it. That's it. This is it. This is
that was what I
unit.
got, but because I saw this 5029 there, I got confused.
And then we're saying that we need that calculation to compute our end. The ending stock is 25% of plan. Right. It should be 25% of the plan sale. So the plan sale following June is July. The following month following June is July. So you have to multiply 25% by July's plan sale, which becomes your ending stock for June. Okay.
Please, I'm okay.
So that is it. All right. So from here, I would plead with you that you follow me keenly, and then because we're supposed to have closed somewhere around 9:20, right? So that we can effectively do this. Okay. So open stock. Remember that opening stock will be the ending stock of month 1 or ending stock of January will become the starting stock of February. Right. That was a conversation that we began with. I don't think I still have section, but it was on the whiteboard. I still don't have it. I don't have it because I lost. Yeah, conversation we set out to before we began all this. We said that ending stock of one particular period. So it would then suggest that the ending stock of January will become stock of February. Okay, so let's see if we can do it. Okay. So ending stock of January becomes the starting stock of February. Okay. Suggesting that ending stock of February will become the starting stock or the opening stock of March. Okay. The ending stock of March will become the start of April. Stock of April the ending stock of June, suggesting that if we are preparing this budget into July, then the ending stock of June will become the starting stock of July. However, because this is a new business, the business has not existed before. So they don't have any stock that existed in a certain old period or previous period. So here becomes a 0. Right. The very beginning becomes the last business of a sort stock for December. So assume any figure than a 0. Okay. If we do that, then we apply what we have. Okay.
How are we supposed to stop that?
Okay, so it's right in the question. Fatia, it's here. It says that it's a startup company. A startup company. Right.
Okay, the
never existed before. But if they had said that the business has existed in the past 2 years or has existed for some time, then it gives you an idea that possibly there may be an inventory that was left in the previous period. And then you may want to work with that.
Okay.
All right.
Well, thank you.
Isaac, I have
Okay, so the concept of opening stock is not the inventory that you have bought to start your operation with.
So it's a finished good.
Right. The concept of opening stock that we said we said that it's a leftover that becoming a startup. Something that you left that we established with ending stock and starting stock. Do you remember?
Yeah, I remember now.
Great. Okay. So let's continue. Maybe your hand is up, or it's an old hand. We move. I have Mavis' hand up, Beatrice's hand up. Okay. All right. So now we may have to put this into test. We're going to add ending stock to sales unit and then take away opening maybe your hand is up. So let's continue. Required production unit. Okay. Sales unit to it. Sorry. Stuff.
It's an open lower height.
Okay. Yeah. We are presenting the budget, and then that's what we are doing. That's why we have it, right? The July came in because we needed the July value to help us get something, right? The July was in because it was going to help us to generate something. That's why we have a working for July. We're going to use it again, so we can just trash it. Right? But just for you to or interest, you are not going in the right. I'm still general production unit, and then my required production unit is simple function, and then my ending stock to sales unit, and then my from that. Okay, but remember, I said we are maintaining this whole number, which will be 15,000. 15,780. Okay, then here will be 18,146. Okay. From here, then we can something very soon for you to take into consideration, right? I want to add all of them from June, okay. All right. What I didn't do up here is that there should be a certain figure here. There should be a certain figure here. That figure ought to be the ending stock at the end of the period. It shouldn't be the total. So here for ending stock, we don't add everything together, just like I have done here, or just like I did here. For ending stock, you are only going to add, you're only going to write the last ending stock that you have in possession. So it becomes 50, 20, 29. So here you don't anything. You only write the ending stock at the end of the period. Yeah.
Let me take you back. So the June, how do you get the 5029? I was a bit lost. If you put the Kaiser on, I will be able to deduce what you did. So just Did the question give you the July plans still?
No, it means you are not in class. You step off.
Yeah, a bit. Yeah, a bit.
Because we've mentioned this a lot of times. Okay. All right. So that is it.
Okay. I'll contact one of my colleagues to explain. Thank you.
Okay.
Isaac, she's not the only one. I beg you, if you can help us know how you calculated the July. Just that one.
Okay. We computed the planned sale or the sales unit for July, right? Even though it wasn't a requirement. But because we had enough information on that, it helped us to compute the planned sale or the sales unit for July. And then the ending stock policy says that 25% per month, right? And then month of June, 25% of this, it becomes the ending stock for June. Right. Just like we did here. You see, if you take the Excel it won't give okay. So we said that ending stock is generated by we multiplying 25% of planned sale of the following month. Right. So that is how we generated January. January was 25% of February's planned sale. February was 25% of March's planned sale. March ending stock is 25% of the planned sale of April. Ending stock is 25% of May's planned sale. May's ending stock is 25% of June's planned sale. And then June's ending stock is 25% of July's planned sale. That is it. Right. Okay. So this will be in the recording. A lot of times I've mentioned this. I'm sure you're going to get it. When you get a recording too, you can have a play with it. Okay. And then I'm taking the opening stock again. Opening stock, the ending stock of one period becomes the starting stock of the next period. So ending stock of January became the starting stock of February. But we are having zero here because this business is a new business. It's a startup. So here becomes a zero. Ending stock of June becomes the starting stock of July. So it doesn't show. But ending stock of May becomes the starting stock of June. That's why here is 4373. Right. That's why we have this here. And then the required production is obtained as we adding our sales unit and ending stock. And then we less opening stock. That's how we generated the required unit. Okay. From here, think about costs. Costs. How much we incurred in producing. So costs. We said there are some cost elements, right? Or cost component. So we mentioned direct material, we mentioned labor, and then we mentioned overhead. So we're going to bring those ones here. The direct material in this context is cost of hides and skins, right? So cost of
I'm so sorry to drag, but I thought that July we could have used the January to do the calculation and multiplied by the 25% to get the July.
How do we do that?
So the 25% of times the 10,000.
The policy, no, we have to pay attention to the policy, right?
Okay.
We are working with a policy, and then that's what we are running with. The policy says that it should be the following month's planned sale. Which month follows June? It's July. So you can't come back to January. The month which follows June is July. So if you want the ending stock of June, it should be 25% of planned sale of July. If you are a big mistake, you can't. Right. Okay.
Hello, please.
Yes.
I got a little bit distracted by my network. So the required production unit. Can you please take it again?
Okay. So the required production unit is a function of your sales unit plus your ending stock minus your opening stock. Right. So 10,000 plus 22,000. 10,000 plus 2,500 minus whichever value is here, 0. That's why we are getting this, right? If you come here, it's 10,000 plus this minus this, and you get this. And then we are repeating this process for the rest of the periods. Okay.
That's fine. Thank you.
Okay. Vera, are you clear with this? So I can continue.
That's fine. I don't want to drag the class. I think I'll check with my colleagues. Maybe is the July figure that I don't know how it was conjured. Sorry. So I'll check with them, please. There are a number of people in the class, so I don't want to drag.
So
please.
I'm going to take it for the last sales. And then sales was 1,000 units for 2 months. The rest of the sales can be 15% month on month. So you can forecast yours up to December. Just that there is a restriction for you to prepare budget for June, right? You could forecast your sales up to December with the 15% month on month increment, right? But because you had a restriction to compute up to June, we ended in June. But we got to a point where July became necessary. So we have to go and work out July's plan sale. That's why we worked July's plan sale, right? We worked July plan sale and then put it down to help us generate the ending stock of June. That's all.
I get it, sir. I get it. Thank you. Sorry, colleagues.
Okay, so when it comes to cost of height and skin, which is the raw material cost, it's 40 cedis. But pay attention here. Your direct material and then, direct labor and then overhead, we're not giving straightforward. You have to work it out. If it's about your direct labor, it's 50% of your cost of heights and skins. If it's about overheads, it's 30% of cost of heights and skins. So that is what you have to pay attention to. So let's compute 50% of 40. That gives 20. 30% of 40 gives what? Is it 12? Help me generate
Yes,
it.
12. Yes,
Okay.
12. Gives 12. Yeah.
Right. So here is 40 cities. Direct labor. Direct labor is 20. I'm sure if you are not in class now, you ask me where we got the 20 and then the 12. But maybe I have to work it out somewhere else. Okay, but I'm saying it again. Direct labor cost is 50% of cost of heights and skins. So if you multiply, let me just work it out here. So 50% multiplied by 40 give us this. All right. So when it comes to overhead, fixed overhead cost is also 30% of 40. And that gives Ghana cedis 12. Okay. What do we do with this? We're going to multiply each and every element here with our required production unit. So I'm going to multiply 40, which is cost of heights and skins, by required production unit. month on month, right? So 40 by the required production unit in January, 40 by the required production unit in February, 40 in that order up to June, right? Up to June. So let's keep going. So 40 times 12,500 in January. And we come to February, it's 40 by 10,375 February. If we come to March, it's 40 multiplied by.
Isaac, please, I'm a bit lost.
Which one?
What are we multiplying it with, please?
We are
What
multiplying
it by?
Cost of 40 cedis by required production unit, right? So all these elements, all the cost elements here, we are going to multiply with the required production unit. Maybe I have to highlight this to guide understanding a bit. Okay, so you are multiplying all the cost elements by the required production unit. Okay.
I get it. Thank you.
Welcome. Okay. All right. Maybe this one will be good. So I'm doing this for all the months up to June. And then I have to generate my total. So the total will be this plus this, plus this, plus this, plus that, and plus this one also. Right. So let me just generate the total. That'll be this, plus that, up to June. And then that gives us a total, right? So I'm adding all the months together. All right. When we come to direct labor will be equal to 20 cedis, right? 20 cedis multiplied by still the required production unit. The required production unit, which is this unit. Okay. And then I'm going to do that for the rest of the months, right? I'm going to do that for months. Okay. When I come to overhead, I'm multiplying overhead, which is 12 cedis. 12 cedis by still the required production unit. All right, so I'm doing that for the rest of the months. Okay, from there, we may have to add all the three elements. So when we add them, we're going to get what we refer to as total cost of production. Total cost. Total cost of production. So total cost of production is going to be an thing. Let me do this. No. Okay. So for total cost of production, I'm adding all these ones. Right. I'm adding all these ones to generate my total cost of production. Right. So take note. All right. So that's my total cost of production. Right. So production. If I go to February, it will be the same thing. Cost of high labor and then phase overheads. So
okay, please, there's a question. So anytime we're dealing with the cost, the unit cost will always be multiplied by the required production units, right?
Exactly.
Okay, thank you so much.
Great. So from here, the next question is that we have to prepare schedule of is it payment to suppliers? Yes. But I told you overhead cost has an issue. Overhead cost, it has some issues with depreciation. So usually when we get here, you want to deal with depreciation before you even continue, right? Before you continue, let's deal with depreciation, because depreciation is included in overhead cost. We may have to take away depreciation. All right. So let's see if you can deal with that. We're told that we're told 100,000. The useful life of the asset is 5 years. The residual value is a 0, right? So let's go to the whiteboard so that residual divided by useful life. Right. If you do that, schedule of what? Schedule of payment to I understand some people are tired. We have to kill it anyway.
Oh, please,
So
let's kill it.
let's try to finish before we sleep. So C, we're looking at, this is not a budget, this is just a schedule, right? So schedule of payment to suppliers. All right. What are we paying to suppliers? What did we buy that we are going to pay? We bought raw materials. So here we may want to think about the raw material cost, the cost of hides and skins. That's what we bought. So you have to bring back the cost of hides and skins down to look at how we're going to pay it based on the policy given, right? So I'm just rewriting the cost of hides and skins. It's coming from up here, this one, right? So that's it. But because I have to use the policy to pay this, let me try to distend it a bit, show it in this format. Oh, some people keep going and coming. I don't know how. It's okay. God will find you. Anyway, so let's see. The policy says that, let's go back to the question. The policy says that suppliers of hides and skins would receive 50% in the month of purchase. So when you buy from the suppliers, they want to receive 50% in the month when you bought from them. So if you bought from them in January, you pay 50% of it in January, and the remaining in the following month. So whatever that you bought in January, you pay it in 2 terms. Pay 50% in January, pay the other 50% in February. What you bought also in February, pay 50% in February, pay the other 50% of what you owe in February in March, right? So it will be in that order. So first, we are going to look at what we bought and then the 50% that we're supposed to pay now. So we are paying 50% now for each month that we have purchased. Then we look at what we're supposed to pay later, which is the last payment. Okay, so let's go back to the work area. Don't sleep. If you sleep, okay. So initial receipt or initial payment, you may have to make an initial payment. When you buy, make an initial deposit. you pay an initial deposit of 50%. So initial payment of 50%. Right. Initial payment of 50%. So whatever that you buy, pay 50% now. So we are paying 50% of whatever that we bought in January. Right. So January, we owe 500,000. Pay 50% of that. All right. So that becomes 50,000. You bought in February, pay 50% of that. Right. We pay 50% of whatever that we bought in February. We bought in March, pay 50% of that now. Right. You bought in April, pay an initial deposit of 50%. So we are paying initial deposit of 50% on each of what we bought. Right. That's what we have generated. Then we're going to look at the last payments that we're supposed to do. Last payment. Right. The last payment too is 50%. Okay. So the last payment, they said we paid it a month later. So it means that January's own, because the business has not lived any time before, you wouldn't have any payment coming from any previous period. So here is 0. You're going to pay its final or its last payment in February. So you're going to pay 50% of whatever that you owe in January. This one, you're going to pay 50% of it in February. What you owe in February, you are paying 50% of it in March. So that one too comes here. What you owe in March, you are paying 50% of it in April, in that order, right? What you owe in May, you are paying 50% of it in June. Suggesting that whatever that we owe in June, if we go to July, you're going to pay 50% of it. That's in July, but we are not thinking about July. From here, we find a total, right? So total, sum. We add everything from here. All right. I wish we can wait till I finish with this and then your questions will come. Then let's see how much you have paid to suppliers. So total payment to suppliers. Okay. So the total payment to suppliers will be an addition of this two. This plus this, then and then the final payment added together. That gives you the total payments made to suppliers. So we generate that throughout the period. All right. So this plus this gives us this. This plus this gives us this. And then this plus this gives us this. Okay, that becomes our total payments that we are making to suppliers. This has tendencies to go to the cash budget, right? Then now let's look at the payment that we have to make to let's look at the monies that we have to receive from customers. Okay, so that becomes the D, right? The D. I'm sure you are saying, hey, this question is it difficult? It's not really difficult, like you are saying. Okay, so schedule of receipt from debtors or customers, whichever way. Okay. Who has the payment terms? At all, what have we even purchased? Sorry, what have we sold? Right. We need to bring what we have sold here. That's what we want to receive. We've made sales to customers. Right. So we are going to bring down here the sales values. The sales values. So the sales values that we dealt with long time ago.
I think we are answering question D.
Okay. So my numbering is wrong. Okay. So D. Thank you. Okay. So we are looking at sales values. I'm rewriting my sales values here. Then what is the credit term? Credit terms, we're saying that customers are expected to pay 60% in the month of sale, right? Whatever that we have sold to customers, we expect them to make a deposit of 60% when they buy or when we sell. And then the remaining will be received in a month following, right? So for January, we are receiving 60% of whatever we sold in January, and we see the other 40% in February. For February, we are receiving 60% in February. The other will be received in March. just something similar to what we saw with the customers, suppliers, right? Just that this one, the percentages differ. Okay, it's not difficult, right? We'll finish right now.
Confusing.
Okay. All right. So initial deposit, initial payment, initial receipt. Normally, that's what I refer to. Initial receipt of 60%. So we are making the deposit, or we are receiving the deposit now, and then they receive the other one later. So let's compute it. So 60% of whatever that we bought in January is received now. 60% of whatever that we bought, we sold in February will be received now. 60% of whatever we sold in March will be received now, all through June. We can look at the final receipts or the last receipt, whichever way that you put it is fine. So final receipts. Final receipt of how much? 40%. All right. So for January, each final receipt will be paid in February. So nothing will show up under January as a final receipt. But when you come here, the final receipts will be 40% of this. Okay, so let's see. And then we are going to receive 40% of February in March. So we generating that as such. Okay. When it comes to money, I think we can leave it in 2 decimal places. So we're going to leave the money in 2 decimal places. So it's fine this way, right? It's fine this way. Okay. Let's generate the total for this. The total will be when we add from January to June. Okay. All right. Okay. So we want to look at the total receipt from our customers or our debtors. So total okay. And then that will be additions of your initial and then the final receipts. So this plus this. Okay. So we're going to generate that for the rest of the month. It's just an addition of the initial and then the final receipts. All right. Okay. Now, from here, we can prepare the cash budget, which is the last requirement. We are almost closing. So we're just about completing it. Okay. Remember that the cash budget, we have 2 key elements. The elements being the receipts and then the payment. So to this budget, we are going to bring everything receipts here. Everything payment, we are going to bring it here. Right. To this budget, to this cash budget, we are bringing anything at all receipts to cash budget. Then anything at all payment is going to come here. But let's segregate them. Let's try to generate the receipts first. Okay. Do you remember any receipts that we've gotten throughout our operations? We received from customers not too long ago. We saw that computation. So for me, I'm going to report my receipt from customers first. Right. I'm reporting the receipt from customers first. Okay. So I will just rewrite what I have here. Right. I will rewrite what I have here. So receipt from debtors. I think I have to just show it as such. Right. And then I put down the figures as it is. Okay. If there are any other receipts that has been generated or that will be generated, it comes.
Isaac, you are muted. Isaac, we can't hear you.
Any other receipts, we bring it here. Okay. Then, because we don't have any other receipts, now we can think about the payments that we've done so far. So payments. All right. So what payment element do you remember? We made payment to suppliers, right? We've made payment to suppliers, so we can bring it here. We made payment to suppliers, so we can bring it here. Okay, so I'm going to bring down the payment that we made to suppliers here. So this is the payment that we did to suppliers. So I'm going back to schedule of payment to suppliers, and then we'll bring the payment down here. Okay, we made payment to labor. That was referred to as wages. You remember? We made payment to labor, and then there was a policy to that effect. So we bring that also here. Okay, so wages. Okay, what's the payment term? What's the payment term? They told us that wages are paid as they are incurred. Wages are paid for as they are incurred. So we bring back wages to this, right? So wages, where do we find it? We're going to find labor in the production budget. Where is it? Where is it? Where is it? Where is it? Yeah, this is it. So we are reporting these figures. Okay. Then we also made payment for overheads. So we are going to bring overhead costs payment here. But one thing which is important with overhead is that for overhead, we are told that it includes an allocation of depreciation. So we may have to take away depreciation from overhead. Right. We have to take away depreciation from overheads. Right. The depreciation that we computed, this is when it becomes important. You first have to take away depreciation from overheads. So let's report here overhead costs. But there was a policy also for overhead costs. It says that overhead costs are paid for a month later. Right. Which is here. Let's go and check quickly and then you'll get back. This is it. Fixed overhead incurred are paid a month later. So this is what we are going to run with. So it means overhead for January is paid in February. However, we are mindful of facts that it includes an allocation of depreciation. So it suggests that because this business is now existing, January will be zero, but we are going to pay January's overhead cost in February. Right. So let's go and check. This is the overhead cost for January. So you have to less depreciation from it. So minus the depreciation. Okay. And that's reported for. We report that for February. And then when you go to February's overhead cost is paid in March. And then that's what we're going to do for the rest of the period. Right. March's own will be paid in April. April will be paid in May. May's own will be paid in June. All these ones, you are mindful that you are taking away their various depreciation from it.
Isaac, you're not, we can't hear you again.
Sorry. So I keep getting interruptions. I don't know. People are tired. So they are calling me that we should end it. Okay. So we look at any other costs. Again, is there any other cost that we incurred? Yes, we bought, if you remember, we bought some equipment on the first day. On the first day of operation, we bought some equipment. Right. How much was the equipment? On the first day, it means the cost was incurred in January. the cost of the equipment was 300,000. So it comes here. 300,000. Is that 300,000? Wait, no, it's 30,000. So 300,000. You don't have anything here again. So 0,000, right? The rest are 0,000. All right. Okay. All right. Do we have any other costs in your reading? Have you come across any other costs that the organization has to pay?
Selling and administrative.
We have selling and administrative expenses. Selling and administrative expenses. Okay, let's see. So that we can, or other non-production costs, selling and admin expenses are expected to be 12,000 and are paid as they are incurred, right? So will you incur selling and administration just in a month, or it will be a recurring? You have to ask yourself that question. This selling and administration will be a recurring cost. Of course, they didn't even tell you at what point in time you incurred it. It will mean that every month you would incur cost on selling, you would incur cost on administrative operations. So it will be 12,000 all throughout. That's based on the question. Okay, so we have to report 12,000 for the periods under consideration. So here will be selling, and administration. Selling at 12,000. Is there any other cost that we've not reported? Have we bought anything else? Did we buy anything else? Yes, we bought inventory on the first day. On the first day of operation, you remember we bought some inventory? Yes, we bought some input. We bought some heights and scans that would help us to test maybe our machine, possibly, right? So that one need to be paid for, right? That one need to be paid for. So inventory of heights and scans or stock of heights and scans bought on the first day is also reported here. Okay, we bought 10,000, not 1,000, 1. Let's check that again.
2,000.
About 2,000, right? We have to pay for this. We have to pay for this. Of course, we know that heights and scans in this 40 cedis. So it's 2,000 multiplied by 40, right? That's what we are reporting in the cash budget. Okay, so this is 2,000 times 40. Okay. All
please,
right.
Isaac,
Yeah,
why times 40, please?
Okay, we're looking at how much we pay for or we buy hides and skins or the raw material. In this particular market, hides and skins is sold at 40 cedis per unit. You remember, as per the question.
Oh,
right.
Okay.
Okay, so that's why we multiplying by 40. And then it was bought on the first day, so it will be 40 times 2,000. Right, 40 cedis times 2,000. Okay, all right. So the rest are 0. The rest of the month are 0. We didn't incur anything again for testing. Okay. I think we've exhausted all our costs or anything in relation to payment. We've exhausted them. So from this point, we may want to generate the total payments, right? We want to generate the total payments, right? We may want to generate the total payments. So total payments will just be additions of all the costs that we've incurred. So check me out. I'm adding from when I made payment to suppliers through to when I paid for cost of heights and skins. So that is it, right? And then I'm going to do this total for the rest of the month. I just want to know the total cost, or the total payments that I've done. The last thing that I may have to look out for will be whether I generated surplus or I'm generating a loss, right? So i.e., we looking at surplus or deficits, right? So that becomes the final thing that we're looking at here. Surplus, or we're having some deficits. We are done. Just keep up with us. There's the last thing to do. Okay, so because this is all my receipts, I will regard that as total receipts, right? That's my total receipts. And then this is my total payment. So i.e., if you're talking about your surplus and deficit, you're looking at all your total receipts minus your total payment, right? All your total receipts minus total payment. All right. So what am I saying at all? I'm saying that for January, we're looking at our total receipts minus the total payment here, right? And then I'm going to check this with the rest of the month. Month 2 or February, I'm still looking at my payment take away from my receipts, and then I'm doing that for the rest of the periods. It's been a very long day. What do you think? Have you learned something new, or it's so disturbing?
Very helpful.
Yes, Ni.
We have learned a lot.
Yes, very
But
helpful.
just that we have learned a lot
Sit
too.
down and then
But
go through again.
but
yes,
please, your
I
wages, did
think
you
I think
multiply
you need
by
to
the
go over
required
the
production
cash
unit?
budget again, maybe at another time. I think because we're pressed for time, we were rushing through. I think we need to go through maybe at another time, especially the cash budget.
Enoch, which of the group do you belong to? Is it weekend or EMBA?
EMBA.
Okay, I think EMBA, we may have a meeting either on Thursday or I think Thursday. I'll talk to the course reps and we see what we can do. For weekend, it's likely I'll meet you on Saturday at your main lecture time, and I'll talk to Teresa about it. Yes, let me pick those who have their hands up.
Yes.
So okay, so please,
my problem is
no.
That's the only problem I have.
Wait.
Wages, did you multiply
please
the unit cost together with the production, with the required production units?
Please let me take from Ni. I'm hands up, and then I'll call each and everyone who raises the hand up. I'll call you. So just put up your hand. I'll call you so that we can have an order in the class. Okay. So Ni, then I'll take from Beatrice, Seto, and then Loretta, and then the rest will come up. I will take it.
Okay, yes, in the question, they said the stock of hides and skin at the end of each month is held constant at 2,000 units.
Let's see.
After
Let's
the
go
stock
back to
of
the question.
yes.
Okay. Where is it?
After the stock of finished goods, the next line, the stock of hides and skins at the end of each month is held constant at 2,000 units.
Okay. So I made a statement about that. That when we hear of hides and skins, is the input, is the raw material, right? So anytime that we hold raw material constant, it would restrict us from preparing raw material budget. And then for me, having gone through all your past questions, they have always held raw material constant, and that we don't prepare a budget for raw material. But in any case that they did not hold that constant, then there should be a raw material budget. Maybe at another time, we can look at a budget that has a raw material budget. It's not difficult at all. Not at all, right? It's not difficult at all. It is prepared just like how we prepare the production budget. But there will be just 2 line items that you have to add up to get the raw material budget. It's simple, but I don't want to bring it here. But take it from me that anytime that we talk about we holding input or raw material, direct material constant, right? If we hold it constant, it means you don't need to prepare a budget for raw material.
For raw material, okay. Because that was where my mind was, the raw material budget, but it's fine.
Okay.
All right. Okay. Thank you.
Beatrice. All right, Beatrice. Beatrice, we can't hear you. Okay, let me pick it from.
Yeah, hello.
Yes.
Yes. Isaac, can we please, I am making a request that if you can take us through profit and loss some other time.
The cash budget or profit and loss?
I don't know which is which, but what I know, profit and loss. I mean, we had a discussion on it with the lecturers. I think the very last lecture we had with the lecturer, but it didn't go well.
I think the financial statement.
Financial statement, sure.
Analysis. Yeah.
Okay, but let me say this. At this very point in time, if you leave me, I'll do all what is relevant towards exam.
That's fine.
Right.
That's fine.
Because sincerely, if you pick your past questions, they don't ask you questions in relation to that, right? But maybe at an extra time after exam, and you want us to discuss something on profit and loss, why not? I'll pick it up, right? But some few months.
Please, at this moment, we will just follow what you want us to do, because possibly, like you said, you know what you want for us.
After
there's been a lot of campaign to from
to just take out the total payments from the total receipts to arrive at either your deficit, or you're going to do the calculation all over.
Okay, so whichever way that you go is correct. So if you have added,
still the same.
Yes, if you have added what I've highlighted, it will give you this. If you have taken away 5,7 something from this, it will give you this.
No, but which one will give us the one tick? The one
which one will give you what?
Tick, the mark. If I use the short one, will I still get the mark? That's what I'm asking.
Yes, even in this class, I've not taught hand a lot, but how to go by shorthand, right? You don't need to be calculating everything. There are certain things you can just do just a runabout and you get the answers.
Okay, then
right?
sir, please, can you go up a little to the schedule of payments and schedule of receipts? I would like to take a screenshot, please.
Okay, let me pick also from
okay, so okay,
Loretta, then we come to
Hello, Isaac.
Loretta.
My line dropped a bit, so I got distracted at the
the overhead
values.
Is it? I didn't get you well. Anyways.
I'm saying that wages.
Okay.
Wages.
Wages. Okay.
Yes.
Okay.
If you can take that part, my line dropped, so I missed that.
Wages labor in relation to direct labor. So your direct requirement or the question says that are paid as they are incurred. Right? Wages are paid as they are incurred. So if you are paying wages as we incur them, then it means that whatever that you owe as labor for January for it, labor for February, you pay for it, and then you go through the same process for the rest of the month. That's the conversation on wages. And then I'm saying that wages relate with labor. Right. Is
so
it okay?
Did you multiply the direct labor by a value? What value did you multiply the direct labor?
Oh, okay. So back to production budget here, right? Is it this? If we pick on direct labor, we multiplied the required production unit by 20 cedis, and then we got this 20 cedis by an instruction in the question that says that the labor cost is 50% of cost of hire. So we multiplied 50 by cost of hires and skins, 50% by cost of hires and skins. Then we multiplied 20 by the required unit. We multiplied 20 by the required production unit.
So that automatically becomes your wage.
Is that part of the administrative cost, administrative expenses? So salary, admin work would be part of the administrative expenses. Okay, Ernestina. Ernestina.
Hello, Isaac. It was about the last question. I wanted you to just run us through, but you already do.
Yeah, I'll take you through that one. Your hand up. It says that managing GNS to finance the deficit, if any. We've seen deficit in this. To comment to the question, and then also how to invest the surplus, right? That's the requirement. That's the requirement. Okay. So in your mind, how will you finance your deficit? Yeah. To talk about this, what will you say? How? Well, in a very, am I muted? No. In a very simplest context, you can get a loan, right? If you are picking up a loan that you picking, is it a short-term loan? Is it a long-term loan? Is it an overdraft? Maybe if you are writing for more points, you can just break this one down. You can also, because it's a new firm, I think doing an IPO will be difficult. Well, it's a company. It's a company, so they can, dependent on which form of company that they're running, if they want to run a public limited liability company, then they can do an IPO, right, to get some more shareholders to join. If not, then they may have to rely on shareholders, ask them to pay in more capital, to contribute more capital. So you can ask shareholders or owners to contribute more capital to this business, right? And then remember the first question, it will be a full transaction on its own. Anyways, then if it's about your surpluses, you can put it in a checking account. You can put it in a checking account. A checking account is savings account, right? You can put the money in a savings account. You can buy short-term notes. Short-term notes. You can think of fixed deposit. You can think treasury works better at a time. You can think about that. Well, for surpluses, you can even think of plowing it back into the business. If you are plowing back your profit into the business, there are a lot of things that you can do with the profit. Either you open up new outlets, or you just span you span your operations from, or you produce more, right? You can think of producing more. You can think of establishing new joints or new outlets from different locations. So think about anything positive that would bring in more money, right? Someone else will say that you can also you can just chop the money, right? The surplus. That won't be an investment. So you may be mad at. But that's it. Okay. Are there any more questions to take? Are there any more questions? Ernestina, your hand is still up, but you are not responding.
Thank you.
Yeah.
The surplus.
Oh, okay. So just look at it. If you have some money with you and you don't have anything to do with it, what do? You just put it in a savings account. If it will not work, you do a high. How do you even call it? Is it fixed deposit? Yes, the bank is deposit. Right. If that one will not work for you, you do a treasury bill. I don't know whether in Ghana's current state you can buy some government bonds, but you have to be careful which example you give, right? So you can buy bonds in a different jurisdiction if it's for you. But in Ghana, if you write that and then maybe the marker find mercy with you, you mark. If not, he can indicate that it doesn't work in current jurisdiction. Okay. We said that you can use the surpluses to expand your operations. Either you looking at producing more, opening new outlets, or maybe venturing into different stuff, maybe within the same sector or going to different sectors. If you have enough, right? But these are monthly surpluses, so you cannot do much with it than you expanding the operations or producing more, plowing back the money into your surplus into your business. Yes. Sato.
You did mention that if someone says they can chop the money, they may be marked down. But then considering that it's a business, and then the shareholders would want to get something from it. If you say that you can declare a dividend or something like that, would you still be marked down?
Well, so declaring dividend may not be a financing option, right? Remember, the question is, how do you finance the surpluses? Recommend to management how they finance, how they invest, right? How they invest the surplus. I think that's the requirement, right?
So the key term is investment, not what you just use it for.
Exactly. And then even that's why I've said that the investment should make enough meaning. It should be reasonable, right? So you cannot just say anything at all, right? The investment that you are talking about should be reasonable. It cannot be anything at all. So in the current market, you cannot go and buy bond, because if you buy bond, if I'm a marker, but you don't know what is happening, they're going to give you a haircut. You are interested in that, it means you don't know what's up. So I'll mark you down.
Thank you, sir.
But maybe the marker can find mercy with you. I may not be the marker. I mean, I don't know. So that's it. They can give you something else. All right. I could see some hand up again, but we've closed though. So as many of you who can go and sleep, you can sleep. Then you prepare for tomorrow's work. I mean, tomorrow I'll pass by the office for a short time and then come home to sleep. Mr. Forson. Hey, no, Stella.
Hi, Isaac. Good evening.
Yeah.
I'm a lady. Yes. So please, I have two questions. My first question is at the production budget. You said that the opening month 1 January 0 because it's a startup company, right?
Yeah.
So what if it's already a company that is in existence and then we still do not have the opening stock from December for the last year?
Oh.
If it's not stated in the question, and what if it's stated in the question? And then
okay, go ahead.
My second question is, you said something about how to finance your debt. I did not ask if you could repeat that. Thank you.
Okay. So financing deficit, you just look at your jurisdiction just to push in more money. This is just 1 month. will investors be even happy enough to bring in more capital? If not, you can think through picking an overdraft, right? You can pick an overdraft. If the bank is going to allow you to pick an overdraft, why not? If not, you can go for a short-term loan, maybe 1 year term, short-term loan. You can pick up maybe a long-term loan if that doesn't work right. Those are the stuff that I mentioned, and then any other areas that you can get money from. This is a company, so you look at whether the company is a public limited or whichever arrangement, whether you can even ask, you can do an IPO, do an initial public offer, something of the sort. Yeah, those are the stuff that I was saying. Yes, if this is an existing business, then the question should give you enough information on how to get the opening stock. Right, the question would give you enough information on the opening stock for the first month. Right, the question can tell you that the expected opening stock is this, and then that will be for the first period. The question can give you the planned sale of the previous period, right, for you to estimate the opening stock of the current period. Okay, so let's see if this question sorry, if this business has existed before, then get back here. Let me show you something small. Computed ending stock. How we computed ending stock was 25%. Is it 25%? Yes, 25% of planned sale. 25% of planned sale of the following month. Right. So if this business has existed before, then it means we could have also computed ending stock for December. Right. We could have estimated the ending stock of December by multiplying 25% by this. Right. And that would have been the opening stock here. Right. But the business hasn't existed before. So how do you worry yourself computing ending stock for a certain non-existent period? A certain non-existing period. But I'm just speaking to you that no matter what, the question will give you enough reason to compute this if it has existed before. If not, and you don't find any reason, then it will be very difficult. Will not come with issues that would help you to compute something here. Is it fine, Stella?
Yes, please.
Okay, Loretta.
Thank you.
Welcome.
Yes, Isaac, please, I will see the last part of your Excel sheet, please.
You don't want us to close? It's time. If we find time again on Thursday, me and then Raymond, let's see if we're able to do something.
Okay, thank you so much. We are
Isaac, please make time for us again, please.
Okay, so Isaac, we'll link up. Why?
Okay,
Sorry?
Raymond. In whose voice is this? Tell you that you and I have to talk.
This is Beatrice.
Right. Beatrice, okay. Beatrice,
what I'm saying is that make time for us for another one.
Is it weekend or EMB? For weekend group, I'm sure when they find me, they will just beat me. Right. This weekend group.
Weekend group.
Because I've not met you guys before.
Yes, not at all.
Anytime that I set up for you, it's either you are in a different class or something. So it becomes a little difficult for me to catch you.
You know what? You talk to our class rep and today, for instance, most of us were not ready, but we had to join.
Okay. But I'll meet you on Saturday. I'll try and meet you on Saturday.
Yes. We would appreciate that. Thank you. Okay. Bye.
Welcome. All right.
Thank you. I'm grateful.
So Reynolds, please, after class, share the recording so that we can with Isaac's permit, we'll know who to share it. Thanks.
Thanks. It was a great time.
Okay. Abraham, Happy New Year. Okay, so a humble plea that I'm ending the discussion.
Thank you.
Welcome.
Thank you very much for the detailed lectures today.
Thank you. Good night, everyone.
Isaac, please, can I see the production budget?
Please scroll up a bit. No, to the first, like A. Okay. Thank you. Good night.